Brad Williams, Frugal Finance. Let's talk about telling a hedge. We've talked about this previously. Let's continue the conversation. Previously, we considered the effect of daily settlement cash flows on future pricing and the performance of futures position. There, we concluded that a correlation between the futures price and interest rates could justify a difference between forward and future prices. A positive correlation between the futures price and interest rates will cause the futures price to exceed the forward price. By contrast, a negative correlation between the futures price and interest rates will cause the future price to fall below the forward price. In interest rate futures, the future price is strongly negatively correlated with interest rates because rising interest rates generate falling interest rate future prices. Daily resettlement cash flows also have potential importance for hedging. If a future hedge generates positive daily resettlement cash flows, those funds will be available for investments once they are received. This means that the futures market hedging gain may unintentionally exceed the cash market loss. While unintentional gains in a future hedge may not seem to be a problem, it is also possible to have the contrary result. For a hedge that is functioning properly, but the futures position is losing money, the futures position may generate losses that exceed the complementary cash market gains. Understand that? You see that visually? Can you see it? In tailing the hedge, the trader slightly adjusts the hedge to compensate for the interest that can be earned from daily settlement profits or paid on daily settlement losses. Thus, the tail of the hedge is a slight reduction in the hedge position to offset the effects of daily resettlement interest. Tailing a hedge can work for any kind of hedging. However, because the daily resettlement cash flows are likely to be more important when the future price is correlated with interest rates, tailing a hedge is most often observed in interest rate futures hedging. Here's an example. A large financial institution plans to buy $1 billion in 90-day T-bill 91 days from now. The T-bill is $975 million. The institution hedges that commitment by buying 1,000 T-bill future contracts. Overnight, interest rates fall by 10 basis points. With this fall in rates, the expected cost of the T-bill increases to $975.25. Lower rates, higher prices. For a cash market loss of $250,000, the drop in rates, however, generates a future gain of $250 per contract for a gain of $250,000. Thus, the futures market gain exactly offsets the cash market loss, or at least it does before we consider the interest on the $250,000 daily resettlement. You see that? You're going to have a margin requirement on this $975 million. Looks like it's going to be $250,000 times the margin requirement, which is probably, well, we'll find out. The $250 daily resettlement flow can be invested for the next 90 days over the hedging horizon. The funds are available for investment for 90 days because we started with a 91-day horizon. We assume an investment rate of 10% with daily compounding in 360-day year. Therefore, the $250,000 will grow to $256,000 equals 250 times 1.1, 90 divided by 360. By the time the hedge is over, for simplicity, we assume that this is the only change in rates. At the end of the hedging period, the financial institution buys its T-bills and still has $6,000 left over. This is the interest from the daily settlement. I said something reversed about if this, I didn't recognize that this was a gain. The $250, if it was a loss, you're going to have an adjustment to your settlement. So let's consider now the original hedge position and assume that rates rise by 10 basis points instead of falling. This change in rates generates $250 daily resettlement outflow that the institution will have to finance for the next 90 days. Under this scenario, the financial institution will not be able to buy the T-bills because it lacks $6,000 at the termination of the hedge. The institution has to pay the $6,000 as interest to finance the $250,000 daily resettlement outflow. From this example, it is clear that the financial institution has traded too many future contracts. The total effect on the futures, the daily resettlement cash flow plus interest, has exceeded the cash market effect. This is true whether rates rise or fall. Why is that? Comment. To reduce these errors in hedging, the financial institution could have traded slightly fewer future contracts with the 10% investment rate on the daily resettlement flow and 90-day investment horizon, every dollar of daily resettlement flow will grow to 1,024 equals 1,000 times 1.190 divided by 360. Therefore, the financial institution can find the tail hedge position by multiplying the untailed hedge position by the tailing factor. In our example, the tailing factor is 1 divided by 1.0241. Notice, however, that the tailing factor is nothing other than the present value of a dollar at the hedging horizon discounted to the present value plus 1 day at the investment rate for the resettlement cash flow. Thus, we define the tailing factor as the present value as of tomorrow of a dollar to be received by the hedging horizon. The tailing hedge position is as follows. Tail hedge equals untailed hedge times tailing factor. In the untailed hedge of 1,000 contracts in our example, the tail hedge would be 976.45 equals 1,000 divided by 1.0241 contracts. Had the institution traded exactly that number of contracts, the results of the 10 basis point change in rates would have been a daily resettlement cash flow of $244,112.50 equal to 10 basis points times 25 basis points per contract times 97.65 contracts. This market effect at the hedging horizon exactly matches cash market effect. In summary, to tell the hedge, we discount the untailed hedge position from the hedging horizon date to the present. Because the tail hedge depends on the time from the present to the hedging horizon, tail hedge changes constantly, even if there's no change in future prices. In the example of the $1 billion T-bill hedge, assume that the investment rate for daily resettlement cash flows is still 10%, but assume that only 31 days remain until the hedge will be terminated. The daily resettlement cash flows will be available for investment over 30 days. The tailing factor in this case is negative 9911. This implies that the tailed hedge position on the state would be 992 contracts. For this example, the tailed hedge grew from 976 to 992 contracts over 60 days. This growth in the tailing factor is just the familiar growth in the present value factor as the discounting period gets smaller. For a hedging horizon of 1 day, the tailing factor is the present value from the hedging horizon to the present plus 1 day. This is no time at all, so the tailing factor 1 day before the hedging horizon is 1. Because futures can only be traded in whole contracts, tailing the hedge requires a large position, such as the 1,000 contracts of our example, to be useful. Also, since the tail depends on the interest rate from the present to the hedging horizon, the tail adjustment can only be as good as the hedger's estimate of the term interest rate from the present to the hedging horizon. In most cases, the tail adjustment is fairly small in percentage terms. In our original example of 10% interest in a 90-day horizon, the tail hedge was only 2.3% smaller than the untailed hedge. The higher the interest rate and the more distance the hedging horizon, the greater will be the tailing factor. However, even in the most illustrative example, the tail is seldom more than 5% of the untailed position. Brad Williams, Frugal Finance, Williams out.